Are they? By the way, as we start our discussion, Jamie Metzl is here, the Atlantic Council's Senior Fellow, and the McKinsey partner, Susan Lund, joins me from Washington. Good to see you, Susan, down the line. And to you, our dear viewer, do have your phone ready, your phone, your laptop, your iPhone, your computer, iPad, whatever it is, because there's a question that you can join in on at cnn.com/join in just a moment. So, Jamie Metzl, the talks with China. There's the real threat of $200 billion more in tariffs, with $100 billion more still to come.
Right.
What happens next?
Well, obviously, the Trump administration wants to have this threat, but they're cautious about going forward. And that's the reason why, even here at the 11th hour, Secretary Mnuchin said, well, we've heard that some people in China want to have talks. Therefore, we're responding to the non-invitation with an offer of talks. So there's a lot of game playing that's happening.
Does it sound as if they want it, or are they making noises?
They're making noises to try to enhance their leverage. Both sides are in many ways locked in. It's not going to be good for anybody if the United States imposes these tariffs, and it's not going to be good for the United States if China doesn't open its markets. There is probably some kind of deal to be had, but everybody is locked in, and that's what makes this situation so dangerous. And the Trump administration is right that China has gotten away with a lot of questionable behavior, but they've done a terrible job of aligning all the leverage to try to drive change.
Susan, the issue could not come at a more prescient time. It is 10 years, bear with me, Susan, it is 10 years since the financial crisis, and everyone says trade worries could be the faller. So answer this question in a sec. Where's the next one brewing? Well, we want viewers to join in first while you're answering it. Get out your phones, your tablets, your computers, go to CNN.com, and this is what you see. Where will it be? The United States with the next crisis, with trade wars and growing debt. Europe with its Brexit woes. China, where growth is slowing, or other emerging markets. Susan?
All right. Well, I think we've done a really good job at fighting the last crisis. So banks in the U.S. and Europe hold a lot more capital. That means that they're safer. The world is also less interconnected in terms of some of the hot money that was sloshing around before the crisis. But, of course, there are still worries. So over the last 10 years of really super cheap credit, lots of emerging markets were able to borrow at historically low rates, and they loaded up on debt.
This is fascinating. 70% of people say that are voting at the moment, CNN.com/join, the United States is the most worrying. And China, which has more problems, Susan, China, which has more problems, arguably, is only down at 7%.
Well, I think that viewers have not seen your show yet, Richard, is the problem here. I think that if we look at debt in China, for instance, it has quadrupled over the last 10 years. So China's companies now have twice as much debt as U.S. companies, adjusted for the size of their economy. So definitely debt is a worry in China, as well as other emerging markets. We're seeing the news in Turkey, in Argentina. Lots of countries are starting to face the fact that they've got a lot of debt, and it may be more difficult to repay when interest rates rise.
China has a bigger problem, but their government has more levers to address it. The United States is in a better situation, but our government is in disarray. And while China has a strategic plan to try to fix their problems, what we are doing in many ways doesn't make strategic sense economically, and it doesn't make strategic sense in terms of standing up to the threat that China poses. Because if we wanted to address the real problem, the real, in some ways, threat to the United States that China poses, we would need to build an alliance of our allies and have a real strategy, and that's not what we have.
Stay with me, both of you, because JP Morgan Chase's Jamie Dimon told Christine Romans the financial world has learned some tough lessons over the last decade.
Absolutely, we're better. There was a flaw. It wasn't just banks. It was the government, Fannie Mae, Freddie Mac. A lot of those things have been fixed. I actually give an example. If Lehman Brothers was to happen today, it wouldn't happen. They would have 2.5 times more equity, 2.5 times more debt, 2.5 times more liquidity. The regulators have the legal authority to take it over, and they have the ability to wind it down in an orderly way. It wouldn't happen, this huge disorderly mess that the collapse of Lehman created. And so the regulators should take a victory lap. They say, you know what, you're right, we fixed that part. Some other things get overdone. Like what happened in the mortgage market was so bad that it's actually people who need mortgages, not subprime, can't get them. Younger people, immigrants, self-employed, prior defaults, because of the litigation and the cost around servicing and origination. The government knows we need to fix that. We need proper regulation, and we should get away from the debate, more is better. Okay? Everyone who's in business knows that some of these regulations become so crippling. When I travel around the country, I talk to small businesses, it's staggering what they have to go through to run their small business. Of course you want clean air, clean water, healthy businesses. You want people punished when they do wrong things. But you should be really thoughtful how you design some of these things. And if you just make it binary, more or less, you're making a mistake. The banks have not asked for Dodd-Frank to be thrown out. Dodd-Frank did a lot of good things. The question is now calibration.
Susan, so the lessons learned and the lessons that could come back to haunt us that haven't been changed. We're clearly safer, but are we safe enough?
Well, I think the one thing that we know is that the next crisis is not going to come from the same source as the last crisis. So I think that Jamie Dimon was absolutely right, that banks learned a lot of lessons. I don't think that we're going to repeat the problems that ran up to 2008. So now you have to think, what are the next risks? We've got emerging market debt. That could be a problem. We have technology playing an increasing role in financial markets. So we've seen some flash crashes in the stock market, sudden drops because of high-speed trading. Now we've got cryptocurrencies that could make asset bubbles. We have robo-advisors, so artificial intelligence advising individuals on how to invest. And we really don't know how these things are going to play out with market dynamics.
Fascinating. Jamie, last word to yourself. Susan talks about robo-advisors, cryptocurrencies, technologies, but square this circle with yesterday's iPhone launch, where we're now prepared to pay $1,400, $1,500, $1,800 for a phone, and look at today's market where tech drove the day, and it's pretty much the game in town, which leaves us where with risk?
Well, risk is going up for two big reasons. One, because as Susan mentioned, technology is leading us to a world that's very different going forward than the world that we've known. That's what exponential change on a J-curve means. It means change going forward is faster than going back. And when we see the intersection of rapid technological change and massive geopolitical change, that intersection, in my mind, is the danger point.
Exponential change on the J-curve. That's why you watch this program, to hear this sort of advice from Jamie and from Susan. Thank you both very much. Now, look, I need to just wrap us up with our where the next financial crisis will begin. Okay, so the US lost a bit of ground in the last couple of minutes. I think they were listening to Susan, but it is still where most of you believe the next crisis will begin. It's split between China and Europe for the rest, but 64% of you say it will be in the United States. Jamie, Susan, thank you very much indeed.